Hi, I'm Cynthia Asen, and today I'm in conversation with Kyle Green. Kyle is a broker owner of the Green Mortgage Team. He has 10 people working with him. On top of that, he helps over 50 agents grow their mortgage business. Since 2017, Kyle has been in the top 25 mortgage brokers in Canada, funded over $1 billion in mortgage financing, and his book, Rockstar Real Estate Investing, is an Amazon bestseller. Why I'm talking to Kyle today is that 80% of his clients are real estate investors. Welcome, Kyle.
Happy to be here.
So thank you for taking the time. This is great.
Yeah, yeah.
So I'd like to start with your life in the mortgage business. You've been doing this for over a decade. You've seen probably the good, the bad, and the ugly.
Yeah.
What's a good thing for real estate investors to do to protect themselves in adverse market conditions?
Yeah, I think making sure that you're well diversified is an important key. You know, as we saw, especially over COVID, with really low interest rate environment, a lot of people were buying real estate in order to take advantage of that situation. Then we saw something we haven't seen since the early 80s, which is increase in interest rates in a really, really crazy speed, right? And I think that what I'm finding is that different clients and different investors of ours have been impacted differently. So those that had a lot of other assets are doing quite well because some of those other assets they're putting into GICs and they're earning a higher rate of return than they would have, right? Whereas those that put everything into real estate and tech stocks, etc., those people are feeling a little bit more. So I think that diversification is a really important thing. A lot of our real estate investors don't like to do that. They like to put their money into real estate. They like the returns there. However, I also think that it's really important that people remember you only make the money in real estate if you can hang on to it for a long period of time. Usually, real estate isn't a short-term investment; it's a long-term investment. And if you get into a situation where you have to sell your property in an inopportune time in a down market, then you probably won't make as much money as you would if you could hang on to it for 10 years long and weather whatever storm comes up.
Right. So maybe a combination of uh, different terms, different amortizations, maybe some fixed, some variable, just really diversifying within your mortgage financing portfolio as well.
Yep, that's right.
Great. So why don't we look at products that are better suited, and how do you figure out, how do you marry the investor to the best lender for that particular lender? What's your process?
Yeah, I mean, part of the process is first about qualifying the borrower. Every lender has their own box, and so back 15, 20 years ago, these boxes weren't as important. You'd go into the bank, go into the branch manager would shake your hand, say, "Hey, Cynthia, how are you doing?" And okay, great, yeah, here you go, here's your approval, and you're good. So the decision making would be localized in nature. Now the decision making on lending is actually centralized. It's the big ivory tower in Toronto that makes all the decisions. And so regardless of who you are now, you have to fit into a product box. Are you fitting into a standard, are you income qualified? Are you a net worth client? Are you needing to use what's called corporate net income if you're incorporated, that kind of stuff. And then there's different guidelines that every lender has. And so especially as a real estate investor, it is harder to qualify. And so one of the things we look at is where do you qualify first? And how do you get the mortgage approved? The next thing then is to figure out, okay, within the framework, which lenders would qualify you? Now, what are the right products for you? In general, we do like three advanceable home equity line of credit style products. And the reason for that is that you can, especially on your residence, that's really the hub of most people's real estate investing. It's usually the property that is the highest value, has the most appreciation, and there's no capital gains in Canada. So there's no tax on that. On the tax front, the other thing that you often want to do is then take that mortgage and pay it down, but then reborrow the money back out and then use that to parlay into investing. And that could be called the Smith maneuver. There's a lot of different terms for it. But effectively what you're doing is you're paying down your personal non-tax deductible mortgage, reborrowing the money back out dollar for dollar because you can reborrow the money that you paid down on the principal back out on the line of credit portion. Now you could use that for the down payment on an investment property. You could use that to invest in many other asset types. And that product, that HELOC, home equity line of credit, is generally what people should be looking at doing, at least in their residence.
For tax purposes, but also keeping in mind if you borrow against your principal residence for investing purposes, make sure you invest. Yeah. It's not to buy a boat or a nice jacket, right? You have to make sure so the interest remains deductible.
Yes. Exactly.
Okay, so maybe talk a little bit about your process at the Green Mortgage team. If a client calls you and they want to buy, what is the best way they can position themselves to work with your team the best?
Yeah, good question. Something that I think is not asked a lot, and something that we always ask every new customer that talks to us, is not just what are you doing today, but what is your plan for the future? Because that plan is really, really important. And Stephen Covey, author of The 7 Habits of Highly Effective People, I like to quote him a lot, and he says, begin with the end in mind. And I think that's really important, because if a customer comes to us and says, I'm buying this property, and you just do that one mortgage, it's important to know, are we doing one mortgage and helping them buy one property because that's their end goal? Or do they want to buy 10 properties? Because the game plan for helping somebody buy 10 properties is very different than helping somebody buy one property. You're going to need to be a little bit more aggressive with how you structure the financing in order to get them to 10 properties. Maybe the lenders that we use for the first few properties are very different, because many lenders cap you at 5 or max 10 properties, depending on the situation. Most lenders are max 5 with them. So understanding what that game plan is really, really important. The second thing is just getting prepared, and unfortunately, it's a lot of paperwork to get a mortgage. Getting a mortgage is not the fun part, but getting it out of the way in advance is really important, because usually what ends up happening as our investors go out and they're looking around and finding a place, and all of a sudden, I found a really good opportunity. Well, guess what? Those good opportunities usually you need to jump on it, and you need to jump quick. And if you then write an offer, and now you have subject to financing, right, and now you have to gather up the documents that we need, that clock might be ticking, and it may reduce your options. It may end up costing you more.
Right.
Right. So getting prepared in advance is really
important. Just getting prepared. Get your income tax returns, any financial statements, all of your bank statements. Get the things that the underwriters, the banks, need to see to support your income. Yeah. I think that, I've done this quite a few years, more than I'd like to say. But, starting out, it used to be net worth was easy to qualify. Income wasn't that important. Today's market is much different. Yeah. It is stated income, and especially if you're using corporate. So you really need to organize all this in an efficient way. And I advise my clients do what I've done. Put it in a digital binder, have it sorted so it's really easy to update, and you can keep that really current. So it's not a lot of collection of data all the time.
Exactly.
Right. Yeah. Okay, so different lenders you mentioned do offer different things. So you would look at the client profile.
Yep.
And then you would look at the lender that's best suited to get them to their end goal, the game plan. I want to buy 10 properties. Okay, here's the process and the plan. So that's good. That's great knowledge for investors in terms of who should they work with. I mean, many of my clients say, oh, I'll just go to my banker. And I really kind of discourage it, because I don't think the bank's looking at your best interest. I think the bank's looking at how can we get the business from you that fits in our current model.
Yep. And
so I do recommend working with an independent agent, mortgage broker, to get that financing. So just some of the nuts and bolts. Variable rate, fixed rate, term, amortization, just kind of cover off what the basics are. There's some people watching this, I'm sure, that don't even know.
Yeah. Well, a fixed rate term just means that the term is set for the term that you choose. Most commonly chosen is 5-year fixed, but different markets and different times will cause a different term to be more popular. For instance, as we're speaking right now, shorter term fixed rates are more popular because the expectation is that interest rates will fall in the near future, and so people don't want to lock in for a long period of time and be paying a premium or a higher interest rate, especially in years 3, 4, and 5. So a lot of people are taking shorter term fixed rates. Variable rates, on the other hand, move with the prime rate, and the prime rate is set off what's called the overnight lending rate, which is what the Bank of Canada sets.
Right.
So it's not quite that the Bank of Canada sets the prime rates, because the banks then can choose what they want their prime rate to be, but they almost always follow what the Bank of Canada is doing. So what that means is that if you take a variable rate, over the last 30, 35 years, a variable has outperformed fixed rates, but that's also been, if you look at the chart, the interest rates have been falling over that time. Of course, you would want to be in something flexible that allows you to take advantage of falling interest rates in that kind of environment.
Right.
The other keys, though, with the variable rate is that the penalty is capped at 3 months interest, whereas these fixed rate penalties, especially with the major banks, can be either 3 months interest or something called the interest rate differential. And the easiest way to explain the interest rate differential is it's the difference between your rate and current market rates over the remainder of the term.
Right.
That means that if the interest rates are falling, then it can be really expensive for the banks to rebook it. And that penalty can be really, really steep. We've seen $500,000 mortgages have $70,000, $80,000, $90,000 penalties in some cases, which is insane.
Read the fine print, is what you're saying. And I think on a variable rate, can you comment on trigger? What's the trigger rate?
Yeah, so we've never had to deal with this ever until 2022. So the trigger rate is effectively, it's a point at which, if you're with a lender who has a fixed payment variable. So some lenders have a variable product where the payment doesn't change as the rate changes.
Right.
So if the payment's not changing, then what's changing? It's the amount that goes towards principal and interest. Now, if the rates keep climbing, then the amount that goes towards the principal and the amount that goes towards the interest keeps doing this.
Right.
Now, eventually, you get to a point where the payment that you're making is not even covering the interest payment.
Right.
And that's eventually when the lenders are going to say, well, you've hit the trigger point.
Okay.
And now that the rate has exceeded this level, now we need to reset your payment. And then they would reset it at the 30-year amortization based off, or whatever amortization you're on, based off of the rates at that time.
The rates at that
And that's where, instead of a lot of lenders where it's a bit of a smooth curve, Bank of Canada moves up or down and your payments go up and down.
Right.
These banks, what would happen is it would just not move, and then all of a sudden there'd be a huge jump.
Right.
And we saw some people have 30 or 40% jumps in their payments all of a sudden.
Right. Yeah. No, that makes sense. So I think that one of the things that I'd like to see is, I look at investment property as long-term hold.
Yeah.
So I think that strategizing about, maybe not taking advantage of the lowest, but more the sustainable. Yeah. Are there such things as 10-year mortgages?
There are, yeah. That's about as long as you can go in Canada. In the US, it's different, 25, 30 years, very common. Right?
Yeah.
I think the reason for that is that internationally, the banks always lend out money and then they pool mortgages together and bundle them up and then sell them. It's called mortgage-backed securities. It's actually what caused the US subprime crisis, because they would bundle up the mortgages and then the rating agency would say that's AAA. Actually wasn't. There's a couple of AAA mortgages sprinkled into a bunch of
suspect,
B-rated and subprime mortgages. But the reason that this mechanism is really important to understand is it explains a lot of how mortgages operate. And that bundling and pooling means that they're actually getting money from outside sources, because third-party investors will buy these bundles of mortgages
for those yields.
Exactly, right? So in the US, international investors are more likely to invest in the US for 30 years, 25 years. It's a little bit harder for Canada to raise that kind of capital. It doesn't stand on the same pedestal as the US does. So 10 years is about as long as many international investors would like to invest in Canada. And so therefore, the longest mortgage terms we typically have are about 10 years. A bit of a different structure. So you can take a 10-year fixed. The rate is, of course, higher.
Mm-hmm.
And on the flip side, what some people have looked at here is that we talked about the IRD penalty, or interest rate differential penalty. You could take the 10-year, but once you're 5 years into it, if you've been in a term for more than 5 years, you legally cannot charge more than 3 months interest. And so you can actually break that 10-year 5 years in and just pay the 3-month interest penalty. So it's almost like an insurance policy, because one way or another, at the 5-year mark of the 10-year term, you paid for the insurance policy, either rates have gone up and you're very happy, or rates have gone down and you can break it with a minimal penalty and then rebook it at a lower 5-year rate. Yeah.
Makes sense. And I think when a client has a variable rate and we're seeing these increased costs quite exponentially, What would you recommend in terms of what should they do? If they're holding the property for a long time, would you recommend maybe looking at longer term refinancing, or would you just, you're here now, weather the storm, let's hope that the interest rates start to fall at the end of 2023, which is kind of what the experts are suggesting?
Yeah, good question. I mean, it's unique to every circumstance. There's a lot of different moving parts, but I'll give you a couple of things that are automatic that you should look at. If you're struggling with the payments, one way to get the payments down if you're in a variable is that you can lock in your variable with the bank that you're already with, and there's no penalties, there's no restructuring, there's no requalification to do that. And so with some of our clients, they're looking at locking in a variable into a short-term fixed rate,
right?
And they get immediate payment relief that way. Now, I actually built a spreadsheet that can compare a variable rate versus a fixed rate of any term, and it'll you can work off of the assumption that we've programmed into it. You can change the assumption if you want, and actually look at which would work out better for you, a variable rate or a short-term fixed rate. And if we look at a 3-year fix versus a typical variable rate mortgage, the variable in many cases slightly outperforms the fixed rate over that 3-year period.
Right.
But if you look at the curve of what's happening to your payments, if you're in the variable versus the 3-year fixed, you're up here to start in year 1.
Right.
Maybe then year 2, you're down to the same, and then year 3, you're below.
Right.
Now, maybe it's not about year 3 for you. Maybe
right.
it's all about year 1.
Right.
Maybe you're really squeezed today, and
yeah.
sure, it would be great to save money, and maybe over the 3 years, you can actually save a bit more money being in the variable. But maybe you need immediate payment relief. So the
right.
first thing is to maybe look at locking in that variable into a fixed.
So that would be really a conversation. It's very customized, very suited to the individual that's in that circumstance, that you would make recommendations. So those are good to know. I didn't know that you could take a variable rate and turn it to a fixed. Do you have to do the same term, or can you pick the term, or is that bank?
Yeah, so you can kind of pick the term. So most lenders have a policy where the term, if you take a 5-year variable, then the time elapsed plus the lock-in term have to equal 5 years. So
okay.
basically, you still have that same 5-year commitment to the bank. So if
right.
you're 1 year in, then you have to lock into a 4-year term
right.
or greater.
Okay. Yeah. Okay. Good to know. Great.
Yeah.
So I think that there's been a couple of things that I'd like the audience to understand. Like, we hear about the term DCR in qualifying for mortgages, and that's really related to the income that's generated by the property. So maybe touch on how they look at this and why that's important, and what an investor should look for when it comes to cash flow.
Sure, yeah. So DCR is a term that stands for debt coverage ratio, and it's a term that they use on the commercial side. So some residential lenders will adopt this type of policy as well. But a DCR effectively means that on the commercial side, it's less about the borrower and it's more about the property itself. So they want the property to cover itself on an income to debt ratio, usually of about 1.2, 1.25, something in that range, which means that they're only going to lend to you enough money where, including the mortgage payments and all the other expenses, there's still a net surplus of cash flow of 20 or 25% above all the expenses.
Yeah.
And that way, at least there's a bit of a cushion there. And it does mean that in many cases, especially in Greater Vancouver, the amount of debt you can acquire on a multifamily property, et cetera, is actually quite minimal. I do analysis all the time on multifamily properties in Vancouver, and you get 25 or 30% of the value lent to you.
Right.
It's just pretty crazy, especially because there's a bunch of tenants in there that are paying 20 years ago rents, and it's quite challenging to get higher loan to values, so higher lending amount on that value. Now, some lenders will adopt that for the residential side as well. So TD and CIBC in particular will often use a DCR when your portfolio reaches certain sizes.
Right.
And then the same kind of thing applies where they need to see that the income exceeds the expenses.
Right.
One of the tricky parts is that lenders actually use their own calculations for vacancy rates. So vacancy rate in Vancouver is what, 1% max, probably less than that.
Yeah.
They use 5%. There's other expenses that they just say, this is the blanket number that we use.
Right.
On top of that, they also have to factor in the stress tested mortgage payment. So not the actual payment you have, but the stress tested payment, which is 2% higher. And so with 20% down payment in many major urban centers, you're already struggling to get cash flow,
Yes.
And then the lenders use their own expenses, and then also they use the stress test rate. And so down payments with those two banks end up often becoming larger when you reach that state where they have to use that debt coverage ratio. Yeah.
So again, plan a
Yep.
mortgage financial plan, which is really important to build so that you understand, what your overall strategy is and how many properties that you want to acquire.
Mm-hmm.
So you're talking a little bit different. So on the commercial side, if you could only borrow 30%, then obviously you need 70% down payment. So again, the amount of down payment that is required is really dependent on property and income.
Yeah, that's right.
So you talked a little bit about the prepayment. So I think we've covered off prepayment penalties. Is there anything else that you've seen very successful real estate investors? What have they done that's been very good for their portfolio?
Yeah. Well, in general, using 30-year or the longest amortization possible, actually on all debt, makes a big difference.
Right.
And the reason for that is that the lenders focus, especially in residential lending, they focus on debt service ratio. So a bit different than debt coverage ratio,
right,
which is that income to debt ratio on the specific property itself. The debt service ratio is what residential lenders use almost exclusively. And that means that they only want a certain percentage of all of your gross income to be used towards all of your debts.
Right.
That number is usually about 44%. Sometimes it can swing a little bit higher, sometimes it can be a little bit lower depending on the situation, but about 44%. So the challenge usually then is sometimes we look at a client's portfolio and they can't qualify for more money, but it's because they're accelerating the payments on their residence, which you think would be a good thing. But the
right,
lender says, well, because you have a $3,000 a month payment
right,
on that $200,000 mortgage on your residence, that is eating up a lot of your borrowing power.
right.
So one of the things we often look at is when I'm getting the surgical gloves on and going into a file to figure out, okay, the ratios are way up here. How
right,
do I bring them down in line? Yeah. You start to go in there and look at, well, that payment's quite high. What if we re-amortized over 30 years?
Right.
You can still make extra lump sums with most banks. So
yes,
a lot of them allow between 10 to 20% of the original principal.
And then an anniversary lump balloon payment every anniversary, or, there's a combination. Yeah.
Yeah. So you can still pay off the residence as aggressively as you want in most cases. If you look at that high payment that you're making, if you just converted it, instead of making it on every regular payment date, if you just started to make the lump sums, you'd probably be able to pay the same amount per year that you're making on the regular payments in lump sums,
and not impact your
debt servicing. Exactly. Okay. So that's an easy one. And car payments is another one.
I knew you'd bring that
car
up.
payments, baby, car payments.
No car payments.
I know all the Albertans are going to hate me for this because you guys all love your F350s and F250s, but one of the keys here is that that vehicle payments, as a function of the amount borrowed, have a way higher payment. So a truck with a $60,000 truck loan might be $1,000 a month.
Yeah.
Borrowing $100,000 or $200,000 in a mortgage would have a lower payment or a similar payment, right? So it makes a really big difference because you can borrow more money on a mortgage because the lower rates and the longer amortization. Usually a truck loan or car loan is 5 to 7 years, whereas a mortgage is 25 or 30 years. Not to mention that with real estate, you're borrowing money to acquire something that should appreciate over time.
Yes.
Vehicles, you're borrowing money to buy a depreciating asset. And so that's why we often refer to mortgages as being good debt, because you're borrowing to buy something that will appreciate over time, whereas vehicle loans, for instance, are usually considered bad debt.
Right.
So there's an inverse correlation. There's a direct correlation between somebody's income and the value of their vehicle. So the higher their income, yes, in general, the higher the value of the vehicle. But there's an inverse correlation between somebody's wealth and the price of the vehicle. That's why we see wealthy people just drive regular average cars. You might be making $200,000 a year and driving a Porsche, but have no cash in your bank account because all of it's going into your Porsche, right? So
we can tell what your pet peeve is. Why do you have that massive car payment? So good debt, bad debt. Good debt is appreciating debt. Good debt is making your money go to work for you. And bad debt is lifestyle. Borrowing to go on a holiday, borrowing to have a nice car. It's kind of called living beyond your means. Great book called The Millionaire Next Door. Definitely worth a good read. It talks about, how do people become millionaires? They live below their means and they save their money, but they also put it to work. So you have a lot of tools in your toolbox. I know that. And so for anyone that would like to receive some of Kyle's information, his spreadsheets, his analysis, a complimentary half-hour conversation with Kyle if you're just starting out, or if you have an existing portfolio, reach out. Happy to connect you.
Yep.
Thank you, Kyle. That was amazing.
Thanks a lot.
Thanks.
Yep.